Retirement is more expensive when you're filing alone. When people talk about retirement planning, most examples assume a married couple, 2 Social Security checks, double the standard deduction, 2 lives spreading tax brackets across the household. But if you're single, never married, divorced, or widowed, the math changes. And a lot of advisors out there never mention your situation. And if you're a single filer with $2 million or more saved, the planning is even more nuanced. Not because you're underprepared, but because the tax system is less forgiving when you're filing alone. And because you've done a great job saving, you could find yourself paying more in tax to Uncle Sam at the end of the day. Today we're going to walk through how single filers with $2 million or more should prepare for retirement. We'll cover compressed single tax brackets, why IRMAA cliffs hit sooner, the absence of a spousal Social Security cushion, why Roth timing matters more for singles, and what you should be doing 5 to 10 years before retirement to stay ahead of this problem. Before we dive into all that, my name's Ryan Knoll, and I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's jump into the video. Let's start with the compressed tax bracket problem. One of the biggest disadvantages single filers face is bracket compression. At lower income levels, single and married brackets look similar, but as income rises, single filers hit higher marginal rates much more quickly. That means the same IRA withdrawal that keeps married couples in a moderate bracket may push a single filer into a much higher one. Roth conversions that look efficient for couples can become very costly for singles, and required minimum distributions later in life create sharper tax spikes. When you have $2 million or more saved, especially in pre-tax accounts, those brackets matter a lot. A single at 73 years old with $2.5 million traditional IRA money will have a first-year RMD just over $100,000. By the time you factor in Social Security, pensions, and any other income sources, they likely top out somewhere in the 24 bracket, or potentially even the lower part of the 32% bracket. A married couple could split that income across 2 lives, and as a result, they are likely in the higher end of just the 22% bracket. This is because at these lower brackets, the upper bound for single filers is generally about half of the amount it is for married. They also get half the standard deduction a married couple gets. So not only do they face compressed brackets, they also receive less tax-free money via their deductions. This makes early intentional tax planning critical. Then there are the IRMAA cliffs, which hit sooner for singles. Medicare premiums are means tested through IRMAA, which stands for Income-Related Monthly Adjustment Amount. The thresholds for single filers are significantly lower than they are for married couples. That means Roth conversions, capital gains, large IRA withdrawals, and one-time income events can push a single retiree into higher Medicare premium brackets much more quickly. And because IRMAA is cliff-based, going just $1 over a threshold can increase premiums by thousands of dollars for an entire year. For a single retiree, this creates tighter margins. Income smoothing isn't optional, it's essential. Based on the example we just went through, where an RMD is $100,000 of income and total modified adjusted gross income is around $200,000, that makes Medicare expenses roughly $400 per month more expensive for a single filer. For married filers at a $200,000 in modified adjusted gross income, they're not even paying the first level of surcharges, so this is where the system gets really unfair. Then there's also no spousal Social Security cushion. Married couples have flexibility in Social Security strategy. There's spousal benefits, survivor benefits, and coordinated claiming strategies. Singles don't have that. You get one benefit based on your own earnings record. There's no secondary check to cushion poor timing decisions or early claiming. That makes your claiming decision even more important. Delaying benefits to age 70 increases lifetime income and inflation protection, and for a single filer, that guaranteed income is often more valuable than it is for couples because there's no backup plan. Social Security becomes your personal longevity hedge. But for single filers who need excess cash flow early, it does not always make sense to wait until the very end at 70. The trade-off depends on how quickly the assets will spend down if you take it early versus delaying. Now there's also the qualitative factors such as life expectancy and security. So just because the math makes sense to delay does not always make it a slam dunk decision. Next, we're going to talk about why Roth timing matters more for singles. Roth conversions are powerful, but the window is narrower for single filers. Because brackets compress and IRMAA thresholds are lower, single retirees often have fewer low tax years available. This means the 5 to 10 years before retirement are incredibly valuable. In those pre-retirement years, you may experience lower income, have bonus variability, delay Social Security, and have no required minimum distributions yet. The window allows you to convert pre-tax dollars into Roth accounts at more controlled tax rates. If you miss that window and force income later, it can crowd out that opportunity. We already covered how the condensed tax brackets and IRMAA penalties can cause thousands of extra taxes annually without strategy. This window is the time to ensure that does not happen. So what does planning 5 to 10 years before retirement look like? Well, for single filers with $2 million or more, the most important planning doesn't happen at retirement. It happens in advance of it. The pre-retirement decade should focus on a couple of key factors. First is tax diversification. If most of your wealth is in pre-tax, you're building a future tax spike. Building meaningful Roth balances early gives you flexibility later on. The same could be said for taxable accounts, where with proper planning and diversification, they can act as what we call here at Nav Wealth a pseudo-Roth account where gains can be taken tax-free. Next is income modeling. You need to know what your RMDs will look like, not just what your account balance is today, and specifically whether the future RMDs will move you up a tax bracket. If they do, it's time to think about a conversion strategy. Then there's the IRMAA planning. Understanding how today's income decision affects Medicare premiums later helps avoid costly surprises. For single filers who did a good job saving, this could literally be $5,000 a year annually in extra expenses if they're not careful. Fourth is Social Security coordination. Even without a spouse, timing is critical. Delaying benefits may reduce pressure on your portfolio and protect against longevity risk. But don't forget to look at the qualitative side of evaluating when to take your benefits as well. Then finally, think about your risk. Without a spouse to share income or adjust spending flexibility, your portfolio must be resilient enough to withstand market volatility on its own. Take too much risk and you expose yourself during down markets. But take too little risk and you might spend down your portfolio more quickly than you realize and face constraints later on in life. Then there's the fact that longevity risk is amplified for singles. Single retirees face another challenge: longevity risk without cost sharing. Married couples share housing, utilities, and many fixed expenses. Single retirees carry those costs alone. If you live into your 90s, which is increasingly common, your income and tax strategy must hold up for decades. This reinforces the importance of stable income floors, tax-efficient withdrawals, avoiding unnecessary bracket spikes, and preserving flexibility. The easiest way to make your money last the longest is to make sure that you have a plan that limits taxes annually, allowing more of your funds to compound over time. Then there's the fact that estate planning looks different too. With no spouse, beneficiary planning becomes more direct. Large pre-tax accounts passed to heirs are subject to the 10-year rule, which can compress taxation significantly for them. Proactive Roth conversions can reduce the tax burden on children or other beneficiaries. Again, this planning must happen before RMDs take control. Before we go over a practical example, I wanted to thank you for watching our video today. Retirement planning as a single filer is not inherently hard, it's just subject to tighter constraints. So if you find this video to be helpful, please throw this video a like and subscribe to our channel. We're dedicating many of the videos in the month of March to single retirees because so much of the advice out there excludes you from plans. So if you're a single taxpayer in or near retirement, you'll want to subscribe to make sure you don't miss anything. Now let's go over a practical example. Consider a 60-year-old single executive with $3 million of total net worth. $2.2 million of that is in traditional retirement accounts, $500,000 is in taxable, and $300,000 in Roth. At full retirement age, they expect their Social Security benefits to be about $3,000 a month, and they spend $90,000 annually. Without planning, this client likely faces a lifetime tax bill around $1.7 million. This assumes they do no conversions. They take their Social Security of $3,000 at full retirement age. They will also pay about $130,000 in IRMAA surcharges in this case, because as they get older and RMDs increase, they will eventually hit the highest tiers of the surcharge brackets. So to recap the do nothing plan, RMDs push taxable income higher, sharply higher that is at age 70 and beyond. Medicare premiums increase slightly. Social Security is heavily taxed, and heirs face compressed inherited IRA taxation. With planning, however, the story is slightly different. The real advantage comes from tax savings from Roth conversions. If at 62 they start with a withdrawal of about $180,000 and use half for spending and the other half for conversions and pay taxes on conversions out of their brokerage account, they will essentially be in the second and third IRMAA brackets for retirement. While in the second surcharge bracket, they would pay about $3,000 per year more in surcharges, and in the fourth, they would pay about $4,500 per year more. And that is just while they're converting. And while converting, they will essentially convert about $1.1 million to Roth and spend down a good chunk of the rest of their tax-deferred funds in the process. This would lower lifetime taxes to about $1 million over retirement, which is a savings in the ballpark of $700,000. We would also recommend to take Social Security at 70 because that's the best numerical answer. But we would still want to evaluate the qualitative factors if they didn't want to do that. But for the sake of the example, let's just assume that they do. So at age 73, they would have the following after accounting for all growth and distributions: $1.7 million in traditional funds, $2.3 million in Roth, and no brokerage account left. Between Social Security and their RMDs on their traditional money, they will still have enough money to live on and still have room for conversions if they wanted. But the point here is they did the heavy lifting up front and have options later on, all while cutting their lifetime tax bill by a little over 40%. So to recap, strategic Roth conversions began around age 60 or 62. Income is smoothed across a little over a decade. IRMAA thresholds are managed intentionally and reduce lifetime costs for Medicare by about $100,000. Future RMDs are reduced, lessening the exposure to increased taxes and Medicare penalties. And heirs are going to end up inheriting a more tax-efficient asset if there's something left over after they're gone. That's the same exact net worth as the previous person retired with, but it's a dramatically different lifetime outcome. And we got it not by following a rule of thumb, but by understanding what the retirement income needed to be and optimizing around that. Realistically, this client could and should spend more money. No one needs to pass with tens of millions of dollars in wealth, which is exactly where this plan is headed. And that now becomes a qualitative side of planning. We know what the optimal end goal is mathematically, but what matters most is quality of life. This person won't outspend their funds. But instead of fully funding Roth conversions, they could use a portion of that money to take trips, pay for kids and grandkids to go through school, give to charities they care about, and do it all right now while they're alive to see that. Essentially live a very fulfilling life because money won't be an issue. Too many planners index on your end-of-life portfolio value. And that is important because you don't want to run out of money. But for this client, that is not an issue. So the next step would be to figure out how much they want to leave behind, then come up with a plan to spend money to get them to that number, not maximize what their beneficiaries will receive. They've worked too hard not to enjoy it. And that example is exactly why generic advice fails single retirees. Most retirement advice assumes marriage. It assumes bracket flexibility. It assumes dual income planning. It assumes survivor benefits. Single retirees operate under tighter tax constraints and fewer safety nets. That means generic advice often leads to higher taxes or missed opportunities. But it's not the end of the world. Understanding where your spending will be, how that impacts the tax bracket you fall into, and then optimizing around that is a great first step. After going through that step, looking how income will grow at certain points, like when you take Social Security or when RMDs start, is next. Then go back and compare that tax picture to your picture today. If you will pay more in tax later because you're in a higher tax bracket, Roth conversions now become your friend. But stay aware of your IRMAA brackets and how that potentially affects Social Security taxability as well. The bottom line here is if you're a single tax filer with $2 million or more, retirement planning requires more precision, not less. Compressed brackets, lower IRMAA thresholds, no spousal Social Security cushion, and higher longevity risk make tax timing critical. The 5 to 10 years before retirement are your most valuable window to shape future outcomes. Handled proactively, retirement as a single filer can be secure and tax efficient. Ignored, it could become unnecessarily expensive. If you want help building a retirement plan tailored specifically for single high net worth individuals, that's exactly what the team does here at Nav Wealth Partners. There's a link in the description below, and we would love nothing more than to find a way to work together to help you through retirement. Thank you so much for watching, and as always, make smart money decisions.